zero DTs just gambling? We did not do a zero DT today, but we did one yesterday. It actually worked out nicely. We've had, what would you say, zero DTs? I would say if I went back and looked at all the zero DT trades we made, I would say, are we up money in total? I would say yes, for sure. But I would say
we haven't been as diligent with them. We don't do them every day.
No, but that's not what I was going to say. What I was going to say is we have done really well when volatility is high and the zero DT trades are cheap. We have done really bad when volatility is low and the zero DT trades are expensive. So like you would think that statistically that things would, even out, but we've done really, really well when we've had high vol. And we've done really poorly when, and I'm talking about vol's been low all year. I'm talking about day to day.
When you get a spike in volatility.
Yeah, we get CPI morning. We've done really well on days when there's some form of a binary event or there's something going on where there's a lot of activity and there's nervousness. We've done exceptionally well around different binary events and spikes in volatility. We have done really poorly on just quiet days. That's all. That's been my biggest takeaway to this point. I would say net on balance, we have basically been trading a 50-50 shot almost every time, and I would say that we're probably running about 2/3 winners, 1/3 losers, and they've been about equal in size. So it hasn't been bad. So I would say at this point, it's been a good experience. It's been good engagement. I would say the actual dollar amount has been pretty insignificant, but it's been a winner.
Very good.
Since the trading volume of the zero DT index has eclipsed all other option volume, that's just on a day-to-day basis. A lot of people have been starting to assert that these options are just another vehicle for gambling. So here at Tasty, we obviously have a different view. Gambling to me is fine because I like to gamble, but the difference is I don't gamble to really make a living or make money because I know that mathematically it's almost impossible. So to me, gambling is not that I don't like it. I do like gambling and it is fun, but the problem with gambling is I won't, like, other than going to a casino and having fun for a night or something, I don't look at it anything different than that just because the odds are so negative. In the trading world, it's very different. And I don't feel like I have any kind of embedded, negative odds. And I actually like the mechanics we have. So in the trading world, I feel very differently about being an active trader. I don't consider it gambling at all. Let's go to the next slide. So gambling, here, they actually say it right here. Gambling is risking money with a negative edge, and the expected loss does not change. The markets are very different. So we decided to throw some things out here to just have a little fun. So casino offerings. If the expected P&L of a $100 wager in sports books, it's minus $10. That's basically the VIG that you're paying. Blackjack gets -3, Baccarat -2, Pai Gow -2, Roulette -5. Those are just that's what the house keeps. That's a pretty big number on a $100 bet.
Sure.
From 10% down to 2%. That's a big number. And then probability of the winning, obviously sports it's going to vary because there's a line to normalize everything. Blackjack, Baccarat, Pai Gow, and Roulette. Okay, let's go to the next slide. So for zero DT options, we know that the majority of the time there is zero advantage of buying or selling them since realized market moves match what is priced into options. However, in times of very high and declining implied volatility, or when implied volatility comes off its lows, there are some profitable opportunities. So what we did here is we looked at the daily average for every month of 2023. And we looked at the average 1 day point move in the SPX to determine, hey, are we over or under that 1 day average? And this I thought was pretty interesting. Tony, we looked at February, March, April, May, June, July, and August so far. And as you can see here, in most cases, the expected move was greater than the realized move. And in only one case was the realized move greater than the expected move. There's a couple of zeros, but so this essentially, now again, we're looking at this from the eyes of a premium seller, not a premium buyer, but a premium seller.
Sure.
But that's what we do: define risk, premium selling, and essentially 1 day options. But when you look at this, you're saying to yourself, okay, well, where is there's no negative. From February to July, there's no negative results on a monthly basis in here, taking the averages. Everything is skewed towards the advantage of the seller. And it's almost always going to be, 10 and a half, 11 months of a year, it's going to look exactly like this. This is completely normal behavior. Expected move is greater than realized move. We know the statistics on this. This is right in line with everything we do. All right?
Yep.
Okay, let's go to the next slide. So, since you can trade either side of this market, the only real cost is the bid-ask differential. In zero DTE options, the differential is usually 10 cents on nearly any option. In this case, they're talking about essentially SPX. So in the SPY, it would be 1/10 of that, which is 1 cent. But in the SPX, it's 10 cents, which again, SPY is 1 cent. Most options can be filled close to the mid price, and that makes the true spread half of what is listed here. So we looked at the bid ask as a percent of option price, and then we also looked at the bid ask spread. And you can see it's tiny. Tiny.
That's what you would want.
Of course. Let's look at the next slide. Actually, go back one for 1 second, John. I just wanted to show here that obviously we mostly live around the at the money, just to show you how tight that is. Okay, because I out of the money 20 deltas or in the money 80 deltas is not realistic for us so much, especially the in the money 80 deltas. That's never us. Essentially, with zero DTs, we're living at the money, which is about the tightest markets. Let's go next slide. So, because the whole trade happens in 1 day, zero DT options make for a great sandbox to test out different strategies where you can set your risk, your reward, and your pop depending on what you want. This is very similar to how we trade earnings announcements. What I like about this is that, first of all, you can fill on basically any kind of order you want. You can get a fill. It's relatively easy. Second is that you can test whatever you want to test. It's an overnight test. It's an overnight expression. Whatever strategy you think, hey, let me see how this works. You learn really fast in here. You'll learn more on the zero DTs than anything else we've ever done. Because honestly,
for good or for bad.
For good or for bad. Well, I'll tell you why. Because on earnings trades, my only regret on earnings trades is sometimes we'll get people to try earnings trades for the first time, but the move will be an outlier move, and the risk.
They hate earnings trades.
And then they hate earnings trades, but the risk will be greater than they thought it was going to be, right? Mm-hmm. But in the zero DTEs, if you're doing defined risk, it just is what it is. There's no outlier moves.
Which brings up a good point here. There's really no adjustment in 0 day options, at least if you're doing a defined risk spread, right? I mean, you could go wide and start selling, a wide strangle or a synthetic iron fly type of trade, but there's really no adjustment here. You really are setting it and forgetting. You really have a market outlook that has to come to fruition as opposed to the trade itself.
So with a bid-ask spread of less than 1%, let's go back to
to the gambling analogy.
Let's go back to the gambling analogy on the first. Yeah. So, and we're not talking about, this is what happens here. This is an embedded, this is the expected loss. These are embedded costs. This doesn't even include this is just your cost of playing the game. This doesn't have, all the odds aren't built, the negative odds and everything else isn't even built into this thing. Well, the probabilities are down below, but these are just the costs. When you're trading the zero DTEs, your only cost is the bid-ask spread, which is tiny because the actual value is mid-price. It's not mid-ask. It's actually mid-price. So it's half of 1%. And compare it here to 10% or 3% or 5%, whatever the number is. That's all. Go back to the last slide, John. Takeaways. So zero DT options are different from typical gambling games because you can choose when and what you want to trade based on the volatility of the market that changes every single day. That's right. So for this year, 7 out of 8 months or 8 out of 9 months so far this year, we have been in a situation where it doesn't matter if you have every single day, the trades have basically been inside of whatever the expectation has been, almost, except for 1 month. So zero DT options are different from typical gambling games because you can choose when and what you want to trade based on volatility, and that changes constantly. And since you can trade both sides of a zero DT option, there is no edge to either party, and the cost of the trade is the cost to trade them is lower than ever. So, like, if you don't like one side, do the other side. So the whole point was it's not gambling, but there just isn't enough time to make strategic adjustments to work a bad trade into a winning trade. That's my only complaint.
Agreed.
That's the only limitation that we have.
Mm-hmm. Very good, sir. Good job by the team. S&P's up 19. S&P's up 19. NASDAQ up 31. We're going to take a quick 90-second break and come back. We got more Tasty Live with Joy, your friend and mine from Tasty Trade, Mr. Scott Sheridan. We'll be back in 90 seconds.